The top 6 stocks to buy during a down market. Even though they are a particularly painful aspect of the market cycle, bear markets are unavoidable. However, investors who focus on the stocks best suited to a down cycle in the markets can lessen some of the financial pain. The S&P 500 teetered on a bear market, or a 20% drop from its peak from a number of months before surrendering on June 13. In contrast, the Nasdaq Composite recently entered a bear market. In any case, 2022 has been a terrible year for stocks with no sign of improvement in sight. Stocks can move sideways for as long as they like, and bottoms are difficult to predict in real time anyhow. Investors may seek to increase their holdings of stocks that show resilience during extended downturns if this trend is to continue. Consumer staples, utilities, healthcare, and even some real estate equities are examples of sectors that are considered to be defensive and thus be the best market stocks. Furthermore, at times when everything seems to be falling in value, companies with a strong history of dividend increases might provide support. Additionally, low volatility stocks with minimal correlations to the overall market typically perform better during bear markets. We evaluated the S&P 500 for stocks with the highest conviction consensus, purchase ratings from Wall Street industry experts in order to identify the best stocks to buy during downturn markets. We further restricted our search to low volatility firms with dependable dividend growth and defensive industry residents. Last but not least, we got rid of any name that wasn't outperforming the market overall during the current downturn. So, with that in mind, here are the top 6 stocks for a bear market. Number 1. CVS Health. When markets turn negative, the healthcare industry has historically been a safe haven. Few sector options have CVS Health's distinctive defensive profile, which makes it stand out from the competition. Although CVS also operates as a pharmacy, benefits manager, and a health insurance firm, it is generally best known as a pharmacy chain. The company's multifaceted business strategy is praised by analysts for both its defensive qualities and long-term growth prospects. We believe CVS is well positioned for the future thanks to its distinctive collection of assets, strong clinical capabilities, and growing presence in the lucrative Medicare market, scale across all of its business lines, a solid balance sheet, and high cash flow production give it the financial wherewithal to carry out recurring capital deployment activities over time. CVS is rated as a strong buy by 9 analysts, a buy by 8, and a hold by 9 experts. Their median target price of $117.77 implies an estimated upside of nearly 26% for the stock over the next 12 months. The stock's minimal volatility is another factor that gives investors comfort. The 5-year beta of the shares is 0.77. A stock's performance in relation to the S&P 500 is measured by beta, a measure of volatility that acts as a kind of proxy for risk. Low beta stocks typically perform worse in bull markets but better in bear ones. That most definitely applied to CVS shares this year. Through June 10, shares had lost 9.7% of their value, outperforming the S&P 500 by 9 percentage points. Due to its tenacity, CVS is one of the best stocks to buy during a bad market. Number 2. AbbVie. Because it belongs to the healthcare industry and is a low volatility dividend aristocrat, pharmaceutical giant AbbVie, ticker ABBV, with a price of $143.20, has defensive qualities. But there are further reasons why the street is firmly bullish on the name. The growth potential and pipeline of AbbVie are quite high on analysts' lists. The street is upbeat about the potential of AbbVie's cancer-fighting and immunology treatments, even though the company is best known for its blockbuster medications like Humira and Imbruvica. After reviewing the model again in light of recent AbbVie's weakening, we were even more optimistic about the pipeline and growth prospects. We believe that the post-2023 growth is severely understated by the mainstream expectation. In the years 2022 to 2023, there are a number of pipeline catalysts that are not predicted by consensus models. The predicted decline in Humira sales is hurting AbbVie, but other medications like Rinvoq and Skyrizi are quickly gaining ground. The bottom line is that on this name, bulls comfortably outnumber bears. 7 analysts rank AbbVie as a hold, 2 as a sell, 4 as a buy, and 11 as a strong buy. Due to a half-century of annual dividend hikes, AbbVie also stands out as a top bear market company to purchase. The low beta of AbbVie is the same. The latter shows a relatively modest correlation to the S&P 500 as shown by the 5.8% increase in the price of AbbVie shares year-to-date as of June 10. That outperformed the market as a whole by approximately 24 percentage points. Number 3. Medtronic. Analysts believe that Medtronic, ticker MDT with a price of $92.74, another low volatility healthcare stock with a lengthy history of dividend growth, is still in a strong position to continue outperforming the market. Through June 10, shares of one of the major medical device manufacturers in the world had a loss of 10.4%, while the S&P 500 experienced a loss of over 18%. More significantly, the street has an implied upside of 23% for MDT over the next 12 to 18 months, with an average price target of $114.45. Because of this, the consensus analyst recommendation is to buy, with a reasonable amount of certainty. In a survey of 25 analysts by S&P Global Market Intelligence, 12 rate MDT as a strong buy, 3 rated as a buy, and 10 rated as a hold. The MDT price is one of its main selling points. Shares are traded at 16.7 times analysts' 2022 earnings estimate at 1. Yet MDT is anticipated to produce average annual EPS growth of above 10% over the following 3 to 5 years. The company has strong post-pandemic growth possibilities from both current and soon-to-be launched goods, which is why we consider this as an acceptable price. Indeed, the street highlights MDT's robust portfolio of current medications, as well as its excellent pipeline of upcoming therapies. We think Medtronic's extensive product pipeline should enable margin improvement and boost sales growth, resulting in high single-digit EPS growth and multiple expansion. The greatest stocks to purchase in downturns frequently give cash back to investors, and MDT has a history that is as strong as they come in that regard. For 44 years and counting, this dividend aristocrat has increased its payout each year. Number 4. United Health Group. It's hardly surprising that United Health Group, ticker UNH, with a price of $484.63 made the cut because blue-chip companies in defensive industries like healthcare often hold up better in bad markets. By a significant margin, this Dow Jones stock is the market's largest health insurer in terms of both market value and revenue. However, UNH's size alone is hardly a justification for holding onto it during a market collapse. Investors can also find solace in the stock's 13 years of dividend increases in a row. The fact that it has traditionally been less volatile than the market as a whole, and the outsized profit growth outlook. Analysts give UNH good marks around the board, with contributions from the Optum Pharmaceutical Benefits Manager division frequently being singled out. It is also a comfort that hospitalizations have dramatically decreased as a result of COVID-19. We continue to rate UNH as a strong buy because we think the stock continues to offer an appealing risk-reward trade-off, and we anticipate management to meet its mid-teens EPS growth rate. The street predicts that over the next 3 to 5 years, the firm will produce annual EPS growth of 15.5%, giving the stock a consensus rating of buy with high conviction. And finally, in 2022, this low-vol stock is performing as predicted. Through June 10, it has lost 3.5% of its value for the year. That outperformed the S&P 500 by about 15%. Number 5. Mondelez International. For many of the same reasons that it's one of the greatest stocks to fend off hot inflation, consumer goods behemoth Mondelez International, ticker MDLZ, with a price of $60.80 is one of the finest stocks for a bear market. Snacks and delicacies offered by the business include Oreo cookies, Milka chocolates, and Philadelphia cream cheese. Because of changing tastes and brand loyalty, Sales of these consumer favorites typically hold up well despite price increases. Analysts note that MDLZ is unique in that it can manage rising input costs because of a long-standing hedging program. Additionally, the business has been successful in passing on increasing expenses to consumers. We have a positive growth forecast for Mondelez because of the company's sales growth, which continues to exceed our projections thanks to good market share results and strong category growth rates. Investors should do well in a challenging market with 9 years of dividend growth and a stock that trades with significantly less volatility than the S&P 500. In fact, by June 10, MDLZ has lost 8.3% of its value for the year compared to the overall market's loss of more than 18%. 8 analysts rate it as a buy, 4 as a hold, and 12 recommend it as a strong buy. MDLZ is one of the greatest stocks to buy in a down market because of its pricing power, market share gains, and low volatility. Number 6. Iron Mountain. A unique real estate investment trust or REIT is Iron Mountain, ticker IRM, with a price of 51.4 cents. The company's legacy business is document management, storage, and protection, while it is expanding into a more contemporary data center division. Sometimes that just means that it shreds them. The good news is that business customers typically store paper documents for quite lengthy periods of time. That level of dependability not only enables Iron Mountain to continue paying out a sizable dividend, but it also makes it possible for IRM stock to trade with just moderate volatility. It's understandable why analysts consider Iron Mountain to be one of the finest stocks to buy during a down market. With significant valuation discounts to more traditional REITs, storage, and data centers, an improving organic revenue growth story, and the very strong likelihood that the dividend will start to be increased at a 5% to 7% annual pace starting in 2023, we view IRM as a defensive stock in the current environment. According to the S&P Global Market Intelligence, only 7 analysts cover the stock, yet their consensus recommendation is a strong buy. IRM is rated as a strong buy by 4 professionals, a buy by 2, and a sell by 1. Their average target price of $61.67 translates into an implied upside for IRM of more than 20% over the course of the next year or so. In a bear market, such returns would be spectacular, but up to this point, IRM has been uploading its end of the bargain in terms of protection. Through June 10, shares had lost 2.5% for the year, outperforming the S&P 500 by approximately 16 percentage points. So there you have it, 6 exceptional stocks that can help your portfolio weather the bear market and give you solid returns. These gems are not only good to hold during bear markets, but during bull markets as well. If you think our picks have merit, don't forget to let us know in the comments below.